gonna I titled the class as being the chessboard because, as you know, the stock market is like a never-ending game of chess, right? And also it's a game of deceit, and also you have to get ahead of the game, or else you're gonna get eliminated from the board. So people need to be cautious, need to do their due diligence on stocks, and I hope that you will succeed on that chessboard and that you prevent yourselves to become a pawn in this game. So eventually I'm gonna cover a lot of variety of topics. So basically it's the basics of topics that probably many people just don't have a full understanding on how the big picture actually works, right? So before we go into before we even go to the main content, is that I give permission for you guys to actually record or take notes from this class, but it is not meant for distribution because I work really hard on content, and that's just for you guys. I'm doing this out of love and dedication. So that's just really for you, all right?
Right. And just not financial advice. Do your own due diligence, trust but verify, and make decisions you're comfortable with. We are actually recording it for our records, but just to be aware that it is a recorded call.
Yeah. So let's get started. So the chessboard of finance. So we're gonna cover a lot of topics, and it's going to be a different, very different topics. But eventually, we're just gonna fuse them together, and it's gonna make sense, right? So first of all, we're gonna explore what is the definition of economics. So economics is actually the study of choices and people. And the importance of the economy depends on individual choices, whether a high school senior decides whether to work or pursue higher education degrees to affect future income, or it could be the government deciding if it's worth going into further debt when we're talking about a market crash or a recession, which would be in order, right? So the study of economics is not needed to understand the world of the stock market, but actually it gives you get more options for your tool belt to make better investment choices. So your government, your politicians, right? Your government representatives use economic theory to guide policy. These legislative bills, once adopted by Congress, are executed under the interests of the Federal Reserve or the Treasury. Their effects could be nationally or worldwide changing and potentially affecting millions, if not billions of people, if we're implying international trading. So as an example, not long last week, we had that Powell conference stating the status of the national economy, including interest rates and inflation, right? And 1 week later, starting today, we have seen a small or a considerable drop of the Asian market. So that's called when they see the effect coming from the U.S. market, while they have this sort of economic tsunami waves. So that's how policy and public interest goes into place when the Fed actually announces something that could be bearish or bullish, and other international markets could be affected. So that's why millions, or if not billions, of people are affected. So also, we have this growing problem, like I've explained in my last class, that the financial world has been increasingly plutocratic. So that means that wealthy people having control of the narrative of how business should be heading in the future through lobbying. So they are very powerful firms, right? They have billions of dollars, trillions of assets. They actually hire lobbyists to influence the political scene in order to kill ideas or create ideas within the Senate or Congress, right? So, of course, we're talking about policy making. So, a theory is rarely wrong in economics because they are based on principles, but technically, policy making is often flawed, and economists rely on data and understanding understanding incentives. So theory is right, but most of them are based on principles, and considering how policy is made and influenced by these lobbyists, well, policy could be often flawed. So that's why we have a conflict of interest between many parties and entities, and there are rules. That's great. That's based on principles, but practically there could be some breaks, and there are practically no enforcement because there are just some fuckery going on with the markets and how market regulators are being affected by these huge lobbyists. So a prime example of flawed policies based on fundamental theories that could create conflicting interests would be, let's say, an example, education, right? So I'm gonna see the situation, what's happening in the U.S. So that's just one of many examples, but that's just on top of my mind. But many people consider being educated to be a fundamental right. If everyone is educated, theoretically, the country would technically thrive with a booming economy, right? But practically, education is seen as a service and a privilege and also because teachers need to get paid down the line. So either education is provided for free in quotation marks through taxpayers, or participants would have to pay themselves for that service to be rendered. So many public educational facilities in the US, like public colleges, public universities, they receive complimentary funds for each student to be enrolled. So they fill up those classes for that purpose, right? However, when we're referring to the theory of quantity versus quality, right? A school can quickly turn programs without giving them a good education. So the schools have the incentive to have more students enroll, so they have like hundreds, if not thousands, per class, right? I'm just exaggerating, but you could see the concept that they kind of give the priority or quantity over quality. So that's why school can quickly turn programs, and unfortunately, the curriculum is so competitive that the piece of paper that is called a college certificate or diploma is a necessity to even enter job that requires certification that do not even guarantee high level positions. So basically, the schools in the US, right, they're practically factories that do not give you guarantee on what you're gonna expect on the market. So there's that. So if people listening to this Twitter space call, right? Of course, when we're talking about markets, they need to understand the role of assets, equities, debts, inflations, policies, interest rates, what else? International trading, embargoes, and also the government plans to improve the economy per term. So every president is a different sheriff in town, right? So we had Trump, so it's a different sheriff, and now we have a new sheriff, who is called Biden. So different plans, different agendas. It is what it is. So you have to understand these underlying concepts. So it kind of helps you placing your investment into the market, which would be much more far, which would be far more easier because you understand what's going on with the country or with the market. So you get the gist. So the idea of autopiloting your finance is practically non-existent because if you autopilot, well, of course, you're gonna rely on a mutual funds or ETFs, right? That gives you a guaranteed return like bonds. But if you want to work hard for the highest profits, well, you have to make a lot of research on those stocks. So that's why due diligence is really important. So the amount of wealth grows depends on the willingness to learn this world, which in turn improves your track performance towards financial freedom and literacy, right? So moving over to the definition of economics, when we're referring to choices, well, of course, you understand that the markets become extremely competitive because there are so many players right now. So we have a lot of retail investors piling into meme stocks, and we all want to share the pie because these institutions have been so greedy, and we're just going to steal that from them. So that's part of the game. So that's why people who have been a part of the game for long, right? understand that the financial world is essentially a chessboard game which never ends, with reviving pieces and a lot of stalemates too. So hence the idea of the name of the class, the chessboard of finance. So on this chessboard, right, there are two spectrums. So the two kings on this chessboard would be fear and greed. The pawns would be cannon fodder, essentially the inexperienced investor. So they're just experimenting the stock market, and eventually they will fail. But failure is part of the experience. So eventually you get more knowledge down the line. So you don't be a pawn anymore. So the knights would be experienced investors, right? The rooks would be different markets, and the fools would be institutions. So if caught unguarded and if they are predatory on the scene, right, the fools can actually screw you up very, very badly, like we have seen so far for many years. The queens would be essentially policymakers and market regulators like the government or the DTCC or the SEC or the options clearing corporations, right? So this chessboard game never ends. And if we're often dealing with stalemates, right? Because the thing is, we basically corner the king. We're gonna overcome fear. We're gonna overcome greed, so you can get the highest profits. But eventually, the stalemates will be over, and the game actually revives with new pieces on the table. So my goal for this class is to prevent you from becoming pawns of this game, and maybe one day you could prevent yourself from becoming a liability if you are willing to put in the work on the stock market. So I encourage you to not become a pawn, right? So I want you guys to be a knight. So the knight would be the experienced investor, or you could be the fool, right? So the fool, I was referring to institutions, but remind yourself that we're actually fools now on the chessboard, because we're essentially, let's say, a movement, right? So we're bringing a revolution down the table, and we're essentially decentralized institutions, making sure that these bad institutions are held accountable. So I like the full piece because it brings a clean slate into the market, and because the fool is also a joker, a trickster, and it is based on deceit, and we're actually deceiving bad short sellers into believing that we're going to fail. But no, we're going to buy and hold these highly shorted securities, so we could actually win and steal those profits down the line from those bad institutions. So either become a fool or the knight. That's great. So there are many topics we would cover. As an example, people could dig into demography and retrieve statistical data like life expectancy, fertility rate, labor cost, income per capita. So understanding demography actually could reflect your investment choices on the stock market. So if we were to understand demography, right, and you would understand the movements of certain companies, recent discoveries have enabled us to believe that China won't be the next world's factory anymore, because for one, the fertility rate has been decreasing over time, because there are restrictions on having children within many families, right? So that comes into line, and of course their labor cost increases, and companies don't want China anymore because those labor costs are too expensive. So, and also you have to figure out that Mexico, India, and parts of Africa are actually the top 3 candidates to lead exportation-based products in the next few decades. So Mexico, we have Dell car companies, Toys R Us, actually. We have Nike, we have Intel. So there are a lot of companies messing with Mexico because there's no trading embargo. It's part of the trading exchange in North America with Canada, Mexico, and the U.S. together. So there are less trading penalties exchanging these products in and out. So you have this idea of democracy, right? So there's a lot of moving pieces that you have to understand that is beyond the stock market. You have to understand that there are a lot of underlying pieces that would affect the price of said underlying security that you would be interested into investing. So that's why I insist that due diligence is extremely important. Like if we were to understand the world of electric cars, right? We need to understand what is needed to build those cars. So where the company is gathering their supplies. So we could see that we need lithium, cobalt, manganese, microprocessing chips, semiconductors, solid state batteries, and so on. So we need to understand how their patents could revolutionize the industry and how likely they'll be their competition. So that's where we see Tesla among traditional car companies that are competing to make the best electric cars out there. So yeah, we understand due diligence extremely important, right? I cannot emphasize this. Do not autopilot your investment. All right, so yeah, you have to understand that we need to be careful about the media because they play a role in this plutocratic market, right? They are part of the chessboard as well. So they condition people by selling fear and drive people away from certain investments. So it would basically create a path for institutional investors to grab some supply at the highest discounts for the highest profits down the line. So you have to understand that. So there is, let me look some of the data on media. Just give me a second. So yeah, they sell. Just on top of my head, I don't remember all the statistical data, but when President Trump actually declared a national emergency because there has to be some kind of lockdown for COVID, right? Well, the media plays a large part of this because people have lost their jobs, have lost their their a bit of their freedom because they cannot go outside. They're basically stuck in their home, and the one of those primal activities would be using computers or going and watching TV, and that's where these kind of ads just show up on your face, right? But these ads bear news actually sell because they create that fear, and people are just hooked up on learning more about those what the media is actually selling you that crap for. All right, all right. So moving on from the media, people also need to understand the law of supply and demand on the market, right? Supply being an ascending curve with demand as the descending curve, right? So we're having the quantity of shares as being the independent variable and the price of these shares as being the dependent variable. So just do X and Y axis. So more information will be available in my future tweets with a clear graph so you can understand what supply and demand actually implies, because it's really important, right? So right now, as an example, for a short squeeze play, let's take the example of AMC, right? We control the supply, so we get to dictate the price, right? So let's move on to another topic, right? There is a sheer difference between being rich and wealthy, right? Wealthy means that people manage to live below their means with an ensuing positive return. So a lot of people have the misconception that being rich means that you have a lot of money. That is actually false. Being rich is relative to the amount of purchasing power that you have. So that is why I want to discuss the importance of inflation, right? So people see inflation as being the rising cost of living. That is actually true. So if inflation is 5% and your job offers you a raise by 3%, well, you're not really rich, you're actually losing money in quotation marks. So you have effectively lost 2% of your purchasing power. By inflation, we're referring to the increase of a currency supply, to the number of people actually using that money supply, actually using it. So prices of goods, commodities, and services increase over time, right? And the common measure of inflation is the Consumer Price Index, called CPI in short. So that's what economists use, CPI, as being the common measure of inflation, right? And the economists just bundle up a list of average expenses on an annual basis, making one basket, and they do another average dividing by a certain amount of years to determine a ratio based on how prices have changed over time. So they use that ratio to basically kind of measure how big the inflation actually is per year. So that's where the consumer price is actually useful in that case. So as you have heard last week, we have heard the Powell conference. He said that inflation is kind of transitory, but also the inflation is real because the Fed target is 2%, but it has been rising, steadily rising up to 5 or 6%. I don't remember the number, but it's been consistently rising, right? And of course, when we're talking about inflation rising, well, that could mean that there's a huge bond sell-off. And of course, when bonds are selling off, the dollar price index, meaning the performance of dollar, would increase, right? And when the dollar is strong, that means that makes stock weak. So that's what happened. We had a lot of liquidation down the line. When the dollar is strong, well, that's where we had those huge sell-off of index portfolios such as the SP 500, the NASDAQ, the Dow 30. There's Nikkei 25, many index portfolios out there. And of course, when we're talking about the dollar increasing of strength, right? Well, that makes inflationary assets like gold and Bitcoin actually experiencing some correction. So that's that. So inflation may be local, as the availability of an important productive or limited assets is scarce, like oil, right? So if there was an oil shortage, like what we had, like the disruption of pipeline in North America, there was supposedly a hack, right? So the increasing price of gasoline will lead to an increasing cost of logistics, right? And of course, this would effectively increase the price of underlying processed goods or related products like wheat, flour, tomatoes, lettuce. You know the gist, because the cost of logistics actually increases because it's dependent on the price of gasoline and oil. So that kind of forces other industry like the food industry to adjust their prices as a result. So that's an example of local inflation. So there was this idea that the fiat currency could be based on the availability of oil, as everything depends on it to deliver goods, or just gold because they don't depend on anything except for inflation changes. So inflation is necessary to check liquidity balance in banks to keep the economy rolling. And that's where the idea of the repo market and the reverse repo market, right? If, of course, the inflation has to be properly controlled on top of liquidity, because too much liquidity in banks, well, that means that the banks are paying on that cash, on that deposit, and that's why the reverse repo market is needed in exchange of bonds, of course. However, a constant rising inflation causes people to lose purchasing power over time, as fiat currency is backed on absolutely nothing, right? So that's why there are some kind of concerns about how the government have been greedy. They have they have allowed their investors to invest on their securities like drunken sailors, and eventually they have increase within the underlying counterparties that they have increased their credit margin and debt, and of course that debt will be overdue, and we, of course we cannot sustain that bullish market because everyone is broke down the line. So there's that. So now there's a rising concern of today's economy that many economists speculate that we're currently in a bubble because at the end of the bullish market, a lot of the stocks don't actually operate on fundamentals anymore. And as years go by, investors give more perceived value into these corporations, making companies good goods and services worth based on how many people pay attention to them, but not exactly on how much they are worth financially, right? So we could take an example of the housing market. So I have posted the tweet about the problem of certain regions like Vancouver and Toronto that have rising price, insane, ridiculous price markups done by firms, right? They are purchasing those residential homes. And now they are, I mean, I've seen those shitty houses with millions of dollars worth on the market, right? And actually, it kind of discourages people to own a home, and eventually they are somewhat forcing low income to middle income earners to go into the rental market instead. And of course, once the firms like I'm saying like BlackRock and Vanguard, they have made a lot of acquisitions of residential homes in the U.S. They make those markups to from 20% to 50%. And that kind of prevents families to own a home, and they're going to participate into the rental market. So based on the law of supply and demand, what happens is that if the firms actually control the supply, they can effectively control the price, regardless if we're on a bullish market or bearish market. It doesn't matter, right? You control the supply, you dictate the price. And of course, they dictate the average rental fees. And of course, we have those ridiculous markups by the millions of dollars, right? And of course, they're gonna be used to basically demolish that house, repurpose that location, and eventually throw up that building for a new condo. And they're gonna make a hell lot more returns on that investment anyway. And perhaps if you're crazy enough to buy a house on a million worth millions of dollars, well, the thing is they still win. But the biggest return for them, they play the long game, right? They destroy that house, that shitty house, right? And they're gonna throw up another building, and here we go. They make some new return on that land on top of on that new condo they're gonna wish to build. So there's that. So by definition, a bubble is a market phenomenon described by surges in asset prices to levels way beyond fundamental value. Technically, we are due for a correction because we have been a bit greedy on the stock market per se. Of course, that's not, of course, except highly shorted securities, which are a different breed, but we're talking about blue chip stocks. They are way above fundamental value. So there's that, right? So I have explained a bit the current economy, how it's a shithole created by those greedy institutions that they have basically created this narrative that the economy is fine with the Fed, and they are actually all complicit into making this economy into a big mess that it's already too late to have this fix. All right, so I'm gonna explain the hedges of bullish on a bearish market, right? So bearish market. So eventually you're gonna see the dollar price index increasing over time because the bonds will sell off, the dollar price index will increase, right? Well, that makes you're gonna see soon a very big dip on Bitcoin and gold and precious metals. So I hope that many of us, right, will have the occasion to have the squeeze first. Then eventually we would have a time window to purchase these inflationary assets, right? And of course, when we're going to talk about the crash, right? Well, the crash implies increased inflation and interest rates. And of course, over time, because inflationary assets are inversely proportional to the value of the fiat currency. Of course, when we're talking about a crash, fiat currency loses purchasing power as contraring to gold. So that's why gold, right? I'm using this example that nothing is gained, nothing is lost, all is transformed, right? So there's that. So we have to understand the importance of gold because gold have been widely used in many countries and many regions that have experienced actually hyperinflation. So in recent memory, we could talk about Venezuela. We could talk about post-war Hungary in 1946. We have Weimar Germany in 1923, Zimbabwe in 2007 or 2013, I'm not sure. There's North Korea in 2013. So when people have experienced an enormous economic downturn, right? And of course, the government is going out of control, printing a lot of fiat currency, and of course, over time, purchasing power will decrease over time. So that's why our people, literally in Venezuela, if you present a small ounce of gold, you would literally buy a mansion with that small amount of gold, right? And I remember back in my studies with Weimar Germany, post-war 1923, the 1 bar of gold is essentially worth like 1 trillion of German marks, which is actually crazy. That's how useless the fiat currency actually was back in the day, that it was so worthless that people just were using the paper of fiat currency and burn it for fuel for their housing because they're so broke. So that's hyperinflation. But of course, I hope that we don't get there. And but there's always that risk, right? There's no such thing as 0% or 100%. So there are just probabilities, but there are risks, and people need to prepare themselves. So hyperinflation, we're talking about hedges. So hedges, gold, or precious metals, or inflationary assets. These are very good. So when we're talking about hedges, right? We're talking about limiting risk on your investment. And people need to understand that even during a crash, people have to live, right? And of course, they need food, right? People were going to invest into food, into the food industry. People would rely on banking. Banking, of course, in the financial sector, they will experience an enormous dip during the crash, but eventually they are the ones faster to recover because people need to use those services, right? So food industry, financial sector, post-crash, there's energy. People need to have electricity in their homes, right? So they have to pay their bills. So energy sector could be a good hedge. So you, so essentially, you have already this experience from COVID, that you understand what is an essential sector. So if you invest into an essential sector or industry, well, you will have your hedge during an economic downturn. So you have to understand that people need to live in essential sectors. So good hedges. And of course, people die all the time. So debt-related stocks, if you're very morbid, you can invest into debt-related stocks. So funeral centers is always a profitable business. So there's that. Ooh, so all right, I'm gonna expand a bit on what happened on the 2008 financial crisis, right? And it was actually a huge huge manipulation coming from the institutions, and they were using that on the chessboard, and a lot of pawns or a lot of pieces on the chessboard got completely wiped out because of the stupidity of institutions, right? So what happened in 2008? So uh, people, right, we have to understand, we have to underline some definitions, right? So we have mortgage-backed securities. So going down to the very basics, so people wishes to buy a home, right, but they don't have enough money, so they have to go to the bank, ask for money, right? So the bank actually lends some money to the borrower, and the borrower would have to pay back to the bank on a monthly installments as loan, right, as monthly payment loans. And of course, the banks would get basically withdraw some of the profits from that mortgage. So mortgage are essentially contracts, and in case that someone defaults on their mortgage, well, the bank would have control of their house. So that's part of the contract. So we have different levels of bonds, right? I'm sure that if you have seen The Big Short, you understand what is the B bonds and A bonds, mortgage bonds, right? So the B bonds are the low quality bonds out there in mortgages, and you have the A quality bonds in mortgage. Also, those are the top quality. So what happened is that the world has led to believe that the mortgage market was insanely strong and profitable, right? And of course, greedy institutions, uh, they have allowed more people into buying those mortgages to basically have this idea of the American dream. So eventually, they allow people with no background checks and no financial statements and no credit scores, no verification process at all. So they allow more people to have these mortgages and have these homes that they wish to have. So banking institutions got greedy, and the rating agencies got into it. They were complicit because rating agency, right? They rated those bonds. They gave those triple A's rating, so 90%, 96% rating. It's like basically Rotten Tomatoes, making aggregate reviews on how the movie would perform. So rating agency is basically Rotten Tomatoes for those mortgages. All right, and of course, the banks cannot track all the performance of mortgages, so they bundle up into what it's called these bonds into mortgage-backed security. So it's basically a bundle of several bonds, bundling up several mortgages together, right? And of course, back in the time in 2008, Michael Burry and Mark Baum found through Jaron Vennet that some of the underlying B bonds are actually shit because they have found out that people with no verification have defaulted on those B bonds, right? And the rating agencies, well, of course, they are being funded by institutions. So good business is good business. So they have lied on the performance of B bonds, and we know that they are the shit bonds among people that they have defaulted on those mortgages. So back in the time, people believed that the mortgages were a fine market, and there were no underlying existing assets to basically short the housing market because people just believed that it was actually a great idea. Michael Burry went to visit Goldman Sachs and I believe Citigroup, and he created an underlying security that would effectively short the housing market, and that is called an insurance policy. So in case that the house is basically burning down, well, you effectively have this return from that insurance policy. That's how shorting the housing market actually works. So he created an asset with the banking institutions called credit default swap, so CDS, right? So that's a way to short the housing market. because he has found that the underlying B bonds have been underperforming. And of course, once the B bonds are defaulting, well, it's going to basically cause a domino effect in the housing industry. And also, when B bonds are not selling well, the thing is, banking institutions, they have found uh, a way to repackage those B bonds, and they created a CDO. So CDO is collateralized debt obligation. So they bundle up those shit bonds that haven't been sold, and they repackage it. And of course, those rating agencies would basically would give them the A rating on those bonds, so they could sell well on the market. So I'm quoting Mark Baum right there on The Big Short. He said that is the CDO are essentially dog shit wrapped up in cat shit. So they are very, very shitty products, and you guys and people who got caught in 2008, they bought those bonds believing these are solid than are more than solid than treasury bonds out there. So people believe in that scam, and that American dream. When the housing market had popped, well, everyone lost their home basically in the U.S. So that's how scummy the institutions are. And of course, I've already explained this before, is that there was a big unwinding process going on with these institutions, and nothing got retraced because they are all complicit. And of course, I've told in my last class, I've explained in my last class that the mindset of institutional investors are very, very different than retail investors, because they can't afford to be careless, because they are based on numbers and data, and they manipulated said numbers and data because they are rich, they are powerful, they have assets, they can hide. And of course, they are so detached from reality that they do not give a shit about the little guys. So that's where the divide is, and there will always will be that divide on the stock market, because people well, the thing is, in my firm, right, we have been taught to be emotionless on our stock decisions, right? But of course, who for whatever institutions, they have been so long in the game, so deep in the game, that they have forgot to be human. So that's where the divide is. And of course, what happened in 2008, they could afford to be careless, and those big firms, those big firms, they of course accept Lehman Brothers, because that was a different story, because they could allow some investment banks to fail. But those very, very big commercial banks, and those very, very big investment banks that were actually complicit into the scam, well, of course, they are critical components of the stock market. And of course, they wouldn't allow a total collapse. So eventually, they would have to save what's left, and they would have to do compromises. So that's why we see those big firms having that too big to fail mentality. And of course, they have this guaranteed government policy to get bailed out. And of course, when are we going to see incriminating evidence? Well, that's where the idea of scapegoating actually works, is that we have retraced those defaulting accounts that was tied to portfolio managers back to Credit Suisse, and there was only one guy who got jailed, and of course the other institutions that got basically complicit into this manipulative chessboard rig from the beginning, they got like bailed out from the government. And that's going to be likely the case in up until today. Of course, regulations are important, rules are important, but we're essentially in a rigged chessboard game. The institutions, they do not care. They know what's going on. They know they already fucked. They know they're already screwed. But the government will basically bail them up for those who are essential, critical to the stock market, and the rest for those hedge funds. Well, Citadel might be disposable. Melvin would be absolutely disposable, because Melvin doesn't bring anything. It's only a hedge fund. But the Citadel would essentially, Citadel advisors would be basically bankrupt. But Citadel Securities, which is the market maker, they control like 1/3 of all U.S. based transactions. I believe that company would have some kind of merger or a deal from the government, but there will be a lot of sanctions from them. So these companies who are critical to the stock market, they will have to be broken down. And of course, those subsidiaries will be basically assimilated under said other companies who are willing to purchase them. So yeah, we're talking about a bit about Hydra. So if you know about Hydra from Marvel, so if we kill one, there are always two replacing those big firms. So that's the idea of the chessboard or finance. So I'm wrapping this class up because now you understand the overall picture of the economy. You understand the pieces of that chessboard, and I'm encouraging you to dig a bit more. If you choose to make your investment strategies, making sure that you read pretty much everything, even the fine print, because you don't want to get caught off guard and improve your game. So you prevent yourselves to become pawns on that chessboard. So you can be, and you could become a knight. So as an experienced investor, or you could be the fool, replacing those bad institutions that we're currently now. So there's that. That's the wrap up for my class. I hope that you have enjoyed this session. So I'm willing to accept the Q&A.
Absolutely. We've actually gotten a few questions during during your time, so I think Alvy should have those ready to go,
Right.
and we'll get into it. That was awesome.
Mm-hmm.
A lot of information.
Yeah, I'm basically filling you with a lot of information. So those are compilations of information that I've learned from Stanford and Harvard, and I'm basically broken down on these concepts, although so though they are actually easy to understand, and that you have to understand the underlying principle that yes, we are all manipulated, but there's a way to not get manipulated and to be ahead of the game.
Yep, absolutely. All right, so we're going to take the texted in or the DM'd in questions first, and then we'll bring some people up
Right.
as we go on. Just waiting on Alvy right now.
So the first question we have is the selling of CDOs, as the banks and hedge funds were doing so in the 1990s to 2000s before the 2008 crash, does that have any correlation with what's going on right now, especially with respect to regulation versus deregulation of banks?
From my side of experience right now, what's happening with the housing market is more like a lack of collateral and more in regards of whoever is controlling the supply. But it looks like the supply has been controlled by big firms out there. So it doesn't have to do with those CDOs and those mortgage-backed securities now, but it looks like the housing market is essentially an engineered outcome, like an artificial bubble. So these big firms are actually preparing to basically hedge against the bearish market, but eventually force people out of their homes so to get into the rental market. So of course, these CDOs and mortgage-backed securities, they will go nada because of that artificial bubble, logically.
And the follow-up question to that is, in your opinion, do you think that we need more regulation to keep the banks and hedge funds in check in these kinds of activities, but not too much where we don't have a balance in free market?
I believe that more regulations are much more needed because there's a realm of hedge funds that they are private companies. They are not as regulated like mutual funds, right? It's only been fairly recent years that hedge funds could advertise themselves to have new investors into their company, but the way on how they functions are really different from mutual funds, which are actually public. So the culture of hedge funds, right? The thing is, they could allow themselves to do those alleged illegal activities in order to have those bigger returns. And the thing is, when you're part of the hedge funds as an accredited investor, they make you a lot of money. And of course, when you make a lot of money, well, based on psychology, is that you wouldn't complain at all because you have this money, and why would you care in the first place? So that's why insider information inside these hedge funds are really hard to nail down to have part as incriminating evidence. And of course, if we don't have enough incriminating evidence, well, it's hard to put those regulations in the first place because we haven't had cases before because of the lack of regulations on these hedge funds because they just can't find anything about them.
Thank you.
So basically, the lack of regulations that stops them from seeing what they're doing wrong on numerous occasions kind of prevents them from having a reason or the ability to start a legislation to prevent it.
Right, and because of the nature of how hedge funds are actually working with accredited investors, so if accredited investors make a lot of money, why would they complain? So that's the culture there.
You want to bring some people up, and we'll go from there.
I have a couple of other questions
Right.
from people asking. One is a set of 3 questions from somebody it's a little bit more AMC specific and specific to our current situation. In reference to what Dr. Suzanne Trimbath has been speaking about, she's repeatedly explained that naked shorts aren't the issue and that failure to delivers are the issue. In your opinion, how do we know Wall Street will actually deliver?
There's no guarantee because they have been. There's no guarantee that they would cover those failure to delivers, right? Because rules are great, but being enforced is another matter. And currently, the situation on the market is that market regulators are being overextended. That's the truth. And there are so many cases for the amount of actual market regulations out there. And the thing is, I'm sure that people have heard that there are FTD bullish signal going on because, of course, every week there is some kind of bullish signal started from a few weeks ago because there have been a ramp up of the price, and of course we control more of the float, and people with their great due diligence have led to believe that we control the float of retail investors control the float of AMC many times over based on the official statistical data provided by Adam Aron himself, by the company itself. And the thing is, the more we control the supply on the market, the more it is difficult for hedge funds or bad institutions to actually deliver those shares because they don't have the supply. Retail investors control the supply. So what you see on the option market is that they are basically creating contracts out of thin air based on supply that are actually IAUs or borrowed shares, but they are actually naked options because they don't have the supply. So once you exercise your options, well, that's going most likely going into failure to delivers because they cannot find the suppliers to fulfill your set contract, and
So
that's where the issue is.
I have a follow-up question, actually.
Yeah,
This is from this is for me. So all these laws aside, in other words, the financial or SEC landscape of a month ago, let's say, with
right.
nothing new being rolled in, um, do you feel that the mother of all short squeezes is still inevitable?
Absolutely. I mean,
Right.
the thing is, there are so many unwinding process. There are so many. The thing is, the rulings, right? The rulings actually force a short squeeze per se, and that's what the current rulings actually imply because they want the rulings actually make sure that future short squeezes do not have the same amplification of what we're having right now. So they're essentially triggering all of these bubbles. They're triggering all the melt ups on purpose, including highly shorted security, so they would pop and prepare for that bearish market to take place because it's are actually unavoidable at this point.
Right. So
So yeah.
so it's kind of like what's done is done, and a lot of these laws they may or may not expedite what's coming, but
Right.
they certainly won't hurt it, and more importantly, they're there to really prevent it from happening to this degree in the future.
Right, that's correct.
I think a lot of people get caught up on, will this law help? Will that law help? And they can only help. That's the reality. Either way, I keep going back to my train has already left the station kind of mentality.
Right. So yeah, the based on data, the mother of all short squeezes is still on play. Um, yeah, I mean even the hedge funds have doubled down on AMC based on the short interest change. And today they have been washing their trade today, so that's kind of expected because the price is actually high. It's overvalued over fundamentals, and they were hoping that they would buy. They were hoping that retail investors would buy into that story to drive down the price even further, but it's not working because buying pressure has been so consistently high, and yeah, they're basically in danger.
And I have a follow-up question from the same individual.
Okay.
Thinking about SEC 002, the difficulty that the SEC and Congress have had enforcing their rules. How do we know that this situation with the stock won't last forever with kicking the can down the road?
It's really hard to say because it's down the line a question of actually having a rule implemented and actually enforcement. But of course, when we're talking about the 801 and 002, right? So we're talking about an automated process into studying counterparties that are defaulting their accounts, and eventually if they cannot pay up on time, their positions will be automatically liquidated. But also it's a case by different lenders. So the lenders, there's even if there's a computer process liquidating and studying stocks, but there's always human bias because there's actually programming involved into coding that software to make those automation work. So they have different parameters depending on the risk tolerance of said institutions. So practically and theoretically are just not exactly in line, but there are always some problems with market regulators, and it's not surprising because those hedge funds have a lot of resources to put those brakes, like lobbying said institutions or Congress. Like
And
005, I remember that it was delayed because of reformatting issues, but my people inside, they told that the hedge funds have hired those lobbyists to put the brakes and delay that process to be happening. But there's a lot of underlying fuckery going on, and it is what it is.
The dark pool information that we were discussing before, as far as the new numbers and all this, as far as the new numbers being somewhat meaningful. You had mentioned there was somebody in your office that with regards to dark pools and the idea that these numbers aren't really anything new. If you can just kind of elaborate on that a little bit.
Yeah, so I'm not a dark pool specialist, so that's why I delegated that task to my ATS specialist. So she's a big expert on dark pools, right? And she uses actually a lot of platforms, a lot of private exchanges to see the performance of underlying stocks, right? And she has checked the performance of the highly shorted securities, among which is AMC, right? And AMC, well, StockGrid, based on the findings that we have, at least on normal stocks, they are actually reliable based on dark pool activities. But for highly shorted securities, is actually a very it seems there's a very big number of disparity going on from the trading shorting volume versus the actual shares being traded back into the NYC for AMC, right? And she suspects that the numbers reported to FINRA are vastly underreported, and that's where she thinks that AMC is kind of a different breed than GME that was back in January. Is that the iceberg uh, is so big underneath that she has basically no idea on how big the rabbit hole is, because what we see underneath might be enormous because of those unreported numbers. And also she thinks that there's some kind of problem with the second book system, and the price that you see on the market is not actually the real price, and there's an underlying second book system that have kind of the real price, and they have been delaying your orders, which was the kind of idea where the stock might be in the late hundreds, if not within the $1,000 bracket. So of course, the prices between dark pools and the NYC are just a mere cent difference between each other. So 5 or 10 cents difference because of processing fees. But they have been collecting these processing fees and these weird hidden fees that have been accumulated over time. So dark pools and commission-free trading, and they have basically created a kind of a simulation world based on their second book system. They have been building their wealth over time, and that's where the price of AMC would have been worth if there was absolutely no fuckery. So there's that.
The constant underlying theme is there's a lot of fuckery.
Yeah, always. The thing is, I see fuckery all the time, and I'm just unfazed by it because it is what it is. And if there's more regulations, great. If there's more enforcement, great. And if people are speaking about it and people are complaining about it, that's great. But fuckery will be always there. And once we have this bearish market, right, and on the next cycle of the bullish market, there will be always fuckery because there's always loopholes happening in the stock market. But whatever.
So how do you feel, aside from the laws that are coming, potentially, how do you feel that the current climate and the knowledge and the awareness that's grown in the retail investor can kind of help offset some of that, fuckery? In other words, I don't think it'll ever be a level playing field, but how do you think we get closer to that, I guess, is my question.
I think the guys from the other side of the fence, which are the rotten apples, so those bad hedge funds, right? They are words on the street. They are actually worried because the retail investors are developing some brain cells, and they are kind of worried because they're losing like tons of profits, and that is kind of unprecedented for them because they use those higher frequency trading. They use those predatory algorithms on their systems, and they watch trades. They box trade all day long, right? But they just don't. They didn't expect. They actually underestimated the power of retail investors, right? And the buying pressure has been so enormous they cannot just stop it. And the thing is, the momentum has already begun, and it's already too late to stop it. And I sincerely believe, like, because I've told many retail investors, right? The thing is, yes, they have a lot of assets to hire those lobbyists, but retail investors, right? We are basically in the millions, if not in the billions of people, and they could just crowdfund a certain amount of money, like millions worth of dollars, and bigger that's a bigger pool of money to actually hire lobbyists, and you could effectively influence Congress by creating ideas of market regulations.
Understood. I have two other questions on my end, and then Alvi, I don't know if you have any other ones, but we'll get into the people that are here right afterwards, I guess.
Right.
One
I
question
have
is,
three more.
all right, can you please discuss Michael Burry and his latest warnings of a market crash?
He's Michael Burry, right? He's actually an introvert, and he's actually very, very actually smart. He has a PhD. He's very, very well educated. He actually he puts his this guy is basically all or nothing. So he drives his investment based on uh, events, right? So if he sees that the market is bullish, he's gonna put those calls on the entire market. If he sees that the market is about to become bearish, or experiencing a possible crash, is going to short the entire market. So that's what all he does to make the highest returns, right? And he implied that we're talking about the mother of all crashes, right? Because he said that also by 2 orders of magnitude, so times 100. So that's a bold claim. But also
So
he said that crypto would crash. Technically, he's right,
yeah.
because the performance of Bitcoin hasn't been so on top of their game, because the dollar price index has been kept increasing. And of course, when we're talking about the stronger dollar, those inflationary assets would have a correction like gold. And meme stock, he said, will crash. Technically, he's right, because as you know,
After the squeeze.
after the squeeze, he didn't say a specific context in that statement, because people need to avoid jumping on the gun and make preemptive conclusions. But technically, he's right. He hasn't said a specific context. So after a squeeze, of course, meme stocks would crash, because the thing is, everything got bought up. So if we're considering like the law of supply and demand, so we control the supply, everything got covered, right? Everything got covered. So on top of official shares, on
Synthetics.
top of shorts and synthetics, everything got covered. So the thing is, the supply is controlled by hedge funds, because they would have covered all of their positions, and of course they go bankrupt. But the problem is there would be no buyers for that stock. So what happens if there's no buyers? Well,
Price
the
goes
thing
down.
is,
Sure.
price goes down, and of
Yeah.
course when the market crash actually happens, so that's where the underlying security would crash as well. So that's what he said. That's what he implied, I think, that yes, he's technically correct to say that meme stock would crash, but he didn't say a specific context when. So
Right.
after the said squeeze.
And in reality, if from everything we've seen, and again, not financial advice, do your own due diligence, trust but verify, make decisions you're comfortable with. But from everything that I've seen, and I think you'll agree, the goings-ons of a squeeze of this magnitude would actually, or potentially will, crash the market. So him saying that there's a crash is actually kind of confirmation that there will be a squeeze, in essence, I believe.
Yes, because before any crash, is that a lot of underlying securities on the market will experience some kind of melt-ups, and I believe those melt-ups are done with highly shorted securities this year.
And then all the long positions get melted down, and the bottom falls out of them, and that's where the
Exactly,
combined effort.
because of the stronger dollar, because they would have to liquidate their positions, and of course, when we're talking about liquidations, the money has to go somewhere else. So people and those hedge funds have to pay up their obligations. So that means covering their short positions. So
Right.
that's where the idea of melt-ups
Right.
uh, is underlined here.
And then they're selling their long positions, which drops the price because now all of a sudden the supply is so much greater and the demand is the same, so the price goes down.
Exactly, correct.
Another question I had from somebody was regarding the staff that you had, or the person in your office that you had that works on a dark pool. They want to know if she would ever consider coming onto a live call with you.
Yeah, of course. Yeah, no,
All
no
right,
problem.
definitely we'll set that up.
Said what?
I said, well, definitely we'll set that up then. That'd be great.
Oh yeah,
I,
okay, yeah, of course, yeah.
and then Alvi, you said you had 3 more.
Yes. Bringing things back to discussing mortgage-backed securities. With respect to the commercial mortgage-backed securities that institutions are now abusing, what will happen on the 30th of June, whenever the relief from the COVID-19 pandemic ends? What is your perspective on that, and the possibility of these mortgages going into default and the fallout that could happen from that?
It's hard to picture a bit about the commercial real estate, because I do not have experience on that, so I cannot have a comment, an educated insight about it.
Fair.
Yeah.
That's fair. Uh, What is your thought again on the housing market? With the hedge funds buying up property at 30 to 40% above the listed price, what's your thought on people as individual investors getting into the housing market and trying to compete with that?
Oof. Well, the thing is, getting into a mortgage on buying those ridiculous prices would be actually very difficult in case that you would have to default, and if you default on that mortgage, and that's going to be very difficult on refinancing on that home because you were defaulting in the first place, and we're talking about those interests of mortgages potentially changing based on the underlying contract. But the thing is, I believe that buying the house as a full price, so not no mortgages involved, then that's where you're the best bet to actually own a home if you're willing to accept that the value of your house would basically dip, but eventually the value of your house would recover if you're willing to stay in that house for several years. But the thing is, either you buy a house right now after the squeeze, not financial advice, and pay full, or the thing is, depending on your region, right? So it depends if firms have been involved into controlling the regional housing market. So if is a big player out there, you might face a supply problem because they are controlling the supply, and of course they're going to decide the price of the regional housing market. So there's that. So it's based on your due diligence to find out if there's a home for you, but it's a case by case basis, so I cannot speak for everyone.
Thank you.
It's all about supply and demand. Of course, these big firms, those big players, they pose a danger on the market.
Okay, and pivoting a bit to the left, if Citadel Securities is doing 1/3 of U.S. trades, and if 40% of those trades are happening on private channels and dark pools, you mentioned apparently that there's a secondary book in play. How are public stock exchanges not affected by this activity?
That's a very good question. Because the thing is, every business out there, so including your pawn shop, your jewelry shop, your convenience store, if they are a very good business, the thing is, there's always a second book system. A second book system is reliant on two ledgers. So first book is intended for the owner of said company or shop that actually registers all transactions in and out, so buying and selling orders. And the second book is actually done for accounting purposes to verify that the transaction has taken place in the first book, but also for processing and clearing purposes. So that's where the second book actually works on the stock market. So the NYC, the dark pools, the hedge funds, all those entities have second book systems, right? But the thing is, the dark pools, right? The dark pools are largely unregulated on the second book system, and also about the underlying potential second set of second book system owned by those bad institutions out there. So if there's a second set of second book system, meaning that they were actually underreport their numbers to the public stock exchange to reflect the price on the market. So the thing is, it's done allegedly. There's no confirmation about it, but my suspicion is that the thing is that the price actually doesn't match up based on the trading volume. So that's the idea of synthetic shares in IOUs on top of commission-free trading, that they have collected, or well, stolen a lot of those fees from their customers, and these also numbers that aren't affected in the second book system. So they have effectively created some kind of simulation world where the price would be without the fuckery, and they have been piling up those numbers, And of course, these numbers aren't reported to the public stock exchange in a timely manner. So possibly they have been delaying orders for all of their customers by 2-3 weeks, allegedly, or even more, a month or two, who knows. But yeah, that is a big fuckery allegedly being involved, but there's no certainty until that we actually bust these hedge funds. So if they go bankrupt, the SEC would have to inspect those ledgers. And of course, we know that incriminating evidence is hard to come by. There's always fuckery around due process and litigation. And of course, most of these hedge funds would be get bailed out. If not, they go bankrupt and they form another company. So there's that.
Thank you. That was a very robust response.
Yeah.
I have 2 questions from another ape who's just DM'd in. Referring to something called the rehypothecation separation account Goldman
Right.
Sachs has opened recently. Could you
Right.
explain that briefly?
Oof. Rehypothecation accounts. So the thing is, the rehypothecation process is when Goldman Sachs, as an example, are opening those accounts in case that the thing is highly shorted securities, right? If you were short a stock that is highly shorted and poses actually a risk into your account, well, that's where margin, the cost of margin and the amount of capital requirements would be required required a lot. So the thing is, the idea of rehypothecation is that those highly shorted securities are very, very high risk. So they are opening these accounts, right, for their underlying clearing members. So it could be Citadel or Melvin, right? So they are shorting Melvin, and they are shorting, AMC or GameStop as an example, and they are high risk, right? Based on their risk tolerance on shorting that underlying security. So they opened up these accounts, right? And Goldman Sachs is saying, hey, this short is extremely risky for your portfolio. So we're going to open up an account, right? And we're going to use your capital to cover your margin. And we're going to use that as a collateral. And meanwhile, you're giving us permission to take profits out of that collateral. So we're going to we're going to take interest out of that and make gains. So they're taking collateral, right? That is liquidity, right? And they're going to invest into other assets to build over time interest. So it's a way to gain profits over said collateral.
And it also takes the volatility or the vulnerability of those basically what are synthetic shares and gets them off their primary books, right?
Yeah.
That's kind
So
of the
just an example, right? They're offering, like, let's say let's give like an exaggerated example so you guys can understand rehypothecation, right? So the thing is, hey, Citadel is offering 5 million as a collateral. So Goldman Sachs and Goldman Sachs are going to use that collateral of 5 million, so as cash, so they can use that 5 million on however they want to gain a profit out of that collateral. So they're going to use that 5 million, right? They're going to create an account. So basically it's a brokerage account used to make profits on the collateral. So let's say if Goldman Sachs is actually retarded and they're going to choose to invest and hold that 5 million into AMC and GME, well, they have the right to make those gains on that collateral to make sure that in case that hedge funds would basically default on that on that collateral. Well, the thing is, Goldman Sachs has some kind of portfolio management over said collateral, and they're making profits on that, on their own investment based on that collateral, if that makes sense.
Definitely, thank you.
It does.
So they're just making gains, yeah.
The follow-up question from the same ape is, if, according to Michael Burry, hedge funds can't own pink sheet stocks, what is your thought on OTC cannabis stocks as a type of investment?
Right now, of course not. financial advice, right? That's just my opinion. Cannabis has not been performing well in the last few recent months. Of course, except the pop up back in January and February. So that was a rare case of melt up from the cannabis stocks, right? And of course, they are disruptive in a way, but not they're not attractive enough volume from retail to actually invest into that world. But I see cannabis as a potential in the bearish market, because I often say that when we're talking about crash, right, a bearish market, well, that leads to increased depression, and increased depression increases actual consumption of vices. We're talking about substances um, like say coffee, it could be cannabis, it could be magic mushroom, it could be psychedelics, it could be beer, it could be wine. So these sectors tend to perform well in a bearish market because people, well, mostly they have lost their jobs. They are unhappy, so they actually consume these products, right? So that could be like an interesting sector as a hedge in the bearish market. So I forgot to include that. So those vices are actually the interesting sector to invest in a bearish market. So these could be considered.
So I think an underlying question in that question was also, though, that the idea that the hedge funds can't do pink sheets, they can't do OTC. So in general, even aside from cannabis, what are your thoughts, or what's the downside? Well, I guess two questions. Is trading in the OTC a good way to be in an environment where you're not affected by the quote unquote fuckery of hedge funds because they don't trade in the OTC? And if yes, then what's the downside to trading in the OTC?
Well, the thing is, OTC is actually a profitable way to experiment on stocks, because there are a lot of new companies that are actually competing to be listed on said public exchange. And then, of course, the thing is, it depends a case by case basis. The thing is, that's where due diligence is really, really important. You have to check up their financial statement on how their products are actually being supplied and where they come from and what their vision of the said company, and that's where fundamentals are actually important through their financial statement. And of course, I mean, I deal with penny stocks, right? I don't deal with pink sheets. I deal with those listed OTCs. I forget what was the name of the set exchange, but the thing is, with those penny stocks, right? The thing is, it requires a lot of due diligence to get into that world, and it's an extremely uh, risky investment choice if you are not willing to put
Right.
it in the work. So that's all there is.
And now, from the standpoint that an OTC stock, obviously having a lesser price, it can go to zero easier, right? You have to do your due diligence to see what the company's really about, like you're
Right.
saying. But if somebody were entertaining the idea of going into the OTC sector or OTC stocks for the purpose of avoiding the fuckery of hedge funds, is there, to the best of your knowledge, any fuckery otherwise, like non-hedge fund fuckery in the OTC?
Well, there are always fuckery going on with the LTC, man. It's just it's not more from coming from institutions, but how company is being made and how companies are being organized to create a said to have this company being listed in the OTC. So there's a lot of Ponzi schemes. There's a lot of pyramid things going on in the OTC. And the thing is, the OTC market is more or less regulated by market regulators. So there's that risk also. But the thing is, I cannot speak for everyone. So the penny stocks, yes, they are very profitable, but you have to make a lot of due diligence to get to you have to make a lot of sacrifices to get into that market.
Right, you're buying companies that aren't really known yet, so you have to kind of figure it out. Whereas a
Yeah,
company that's
and there are
established,
a
there's
lot
more
of
data out there.
Ponzi's and there are a lot of pyramids, and you have
Right,
to read the fine print of said penny stocks.
got it. Thank you. Alvi, anything else, or I'll start letting some people up?
Yeah, the messages have been pouring in the last 10 minutes or so.
All right. So what I'll ask Kringle is because I know this. Trust me, we both know that this can go on forever. What kind of time do you want to spend from now?
Let's say I would stay here until 8 o'clock 15 Eastern. So 30,
All right.
30 more, 35 minutes.
Got it.
Okay, so at what point is the reverse repo rate showing serious issues in terms of the value lent, and at what point do you think it's maxed out?
There's no maximum value in terms of reverse repo market because the thing is, the banks are having this liquidity issue. They have too much Bitcoin, so a lack of collateral and too much liquidity from the bank, so they have to pay a lot of interest out there. And of course, the thing is, the truth is, yes, they're making a lot of profits, but at the same time, they owe a lot of money of the system. So essentially, they all counterparties, including the government, are actually broke because credit, margin, debt.
And as a follow-up question to that, how does June 25th relate to decreasing in repo funds?
I believe that the thing is, when we're talking removing liquidity from banks, because the Fed has somewhat promised that they are kind of decreasing the momentum on reverse repo numbers. And of course, when we're siphoning liquidity from the banks on a continued process, so that's where the idea of rising interest rates and inflation goes, right? And people are just worried that that high inflation or interest rate would spiral out of control. So that's what the government has led us to believe, that everything is in control for the sake of keeping their presidential ratings, and of course not and to prevent massive population panic. So there's that.
And wrapping around back to a final bigger picture question related to AMC in particular, if the price is going to an essentially astronomical level, what are your thoughts on the possibility of the government stepping in to put a stop to it? And related to that, the possibility of how the MOAS could be essentially a type of managed event, how they could be manipulating that.
The thing is, I have a hard time seeing that the government would intervene into said short squeeze, because the thing is, POTUS has showed his apparent support for retail investors, so for the American middle class to make a name against Wall Street, right? To make a stand against Wall Street. So the thing is, if the government would step in into the short squeeze, it will be practically career suicide for the entire administration. So there's that. And thing is, the we want those hedge funds, those bad institutions, to be held somewhat accountable financially. So we're expecting some bankruptcy down the line. And of course, if they cannot close out their balance sheet, their insurance would kick in. And of course, if their own insurance cannot pay out, well, that's where the clearing corporations or said brokerage would pay out the difference to hope to close out their balance sheets, because those positions have to be covered. And of course, if we're holding long enough and way long after that, hedge funds are bankrupt and clearing corporations are basically drowning, that's where the idea of the government would actually print to inject that money into the stock market and bail out the critical components of the stock market. So we're talking about those huge firms, those big commercial banks, those investment banks, right? they have to keep these in line in order to prevent a total collapse of the stock market. But of course, when the clearing corporations are starting to default, well, they have to bail them out also because they are critical components of the stock market. So when they bail them out, they have that money coming from the government. Well, they go into covering these positions, shorted positions as well. So there's that. The thing is, yes, there is some kind of government intervention, but the only limit that it could do is by actually print in case that clean corporations and those involved into shorting the stock are actually defaulting. So there's the idea of bailouts, and that's it. That's the only way that they could do. But in order to save the market and also making sure that we're getting paid.
Right. So the bottom line, because that's probably one of the most popular questions of late. You know, people talk about, well, if this gets to some exorbitant number, will the government just step in and shut it down? The answer is no.
No,
Right?
no.
There's no incentive for them to do it. If anything, it's better. It's in their better interest to let it happen.
It's supply and demand. It's fair.
And they get a lot of tax revenue.
Yeah, and if we cause hyperinflation, well, it is what it is, but it is what it is. The thing is, the thing is supply and demand, and if they kill that principle, it will kill the trust of retail investors into the stock market in the first place, and also that's going to kill the presidential rating of Biden. And he wouldn't want that to kill his own administration anyway. So there.
I think it would. I would think it would even reach other shores where now other countries wouldn't feel comfortable investing in the U.S. stock market.
Right, and the thing is that the world would be blaming even more the U.S. if they would stop the short squeeze in the first place. I mean, come on.
Absolutely, absolutely.
The thing is, undoubtedly, is that the international markets will blame the U.S. and of course the U.S. will blame on poor people because it's always the same narrative since 2008. Nothing has changed.
Yep.
And
Yep.
I don't believe that the government would be happy to have more backlash coming from retail investors because they have stopped that phenomenon from happening. So they don't want that for sure. They don't want to kill their careers for their said intervention, right? So there's that.
Yep.
They would have to print if they have to. That's it.
Right. They just turn the machine on for a couple days and everything's good. They've done it before.
I've had a couple more last-minute questions roll in. One of them related to what you were just talking about. If money is going to be getting printed in order to deal with the fallout from the MOAS, how does that affect inflation issues and the market as a whole with all the additional cash being printed?
The other thing is, more cash being printed, it just decreases your overall purchasing power. And the thing is, there's actually a risk. I mean, the thing is, it depends on our greed, right? It depends how much we're satisfied. And of course, that depends on the thing is, the actual truth is the economy has been running into a shithole, and the government hasn't backed their fiat currency on nothing. So that's since 1970. It was actually an end of the fiat currency depending on gold. And of course, they have been printing, and the world has been so greedy. We have been, as a collective, right? We have been investing into the stock market like drunken sailors. And the thing is, there's like 0% fundamental value and 100% perceived value, and the rest is just psychological warfare going on. It's just like a giant circus, right? And what's the thing is, it depends on our greediness to hold that stock to sit to the moon, right? And of course, in the case that the printer machine is out of control, inflation actually increases, and that's where the risk of said hyperinflation, because we're not responsible, but we're just contributing factors leading to that hyperinflation, that risk, right? But the thing is, where we need to tread carefully as a collective, as a society, to prevent hyperinflation. Because the thing is, maybe you're gonna get millions of your attendees, like 10 millions, and down the line, and we're talking about hyperinflation, maybe your purchasing power is just equal to 1 million of attendees, even if you have 10 million. So imagine bringing a wheelbarrow of cash just to buy a loaf of bread. So that's what hyperinflation. So hyperinflation is essentially an increase of inflation by 50% every fucking month. So just watch the price of bread or milk or any commodities out there going out of control on a monthly basis, and you would be very, very unhappy when that happens. But the thing is, don't be worried about it. I believe that the government has this situation hopefully in control. So just believe in your country that they will do their best in your interest to make sure your ass is being safe and that you could enjoy the attendees, or just, I don't know, have an exodus to Malta and have some fun. But I don't know.
Let me ask you this: if there was hyperinflation and we had our, X amount of attendees, how long would you actually have to wait it out before the inflation was put under control and then your attendees were worth what you thought they were going to be worth originally? We're talking years. We're talking decades.
It's a case by case basis. I cannot speak on that. I mean, the when I remember the case on Zimbabwe, right? I believe hyperinflation started in 2007, and it was just until 2015 that they decided that their currency is absolutely worthless because of hyperinflation. So they actually killed their own fiat currency and they replaced it with the US dollar. So that's how bad it was, because their currency was absolutely worthless. So there's a thin line, because we know that the economy is in really bad state, because overall the institutions have been greedy and they have been kicking the can down the road, and they have prevented the market from going into a correction. And of course, when the SP 500 has been skyrocketing, well, of course, when there's value added into index portfolios, so is the sense of debt, margin, and credit. So there's that. But the thing is, you have to. That's why I keep telling people that yes, it's nice to have your attendees, but it is, once you get your attendees, I mean, the data is actually pretty much conclusive. There are actually signals that the bearish market is around the corner, and you have to prepare to purchase these hedges when you have this time period down the line, because that bearish market might be something that it has never been seen before in many years, and even beyond current living generations. So there's that. So that's why purchasing hedges like precious like inflationary assets like gold and Bitcoin, or essential stocks such as food industry, those those essential sector that from COVID. So I'm not going to go into that, but you understand the gist of what might be at stake when you're not prepared.
Absolutely.
So I have a couple more granular questions that have come in the last few minutes. One is how can we look at the ABX index tracking the risk level of the top 20 subprime mortgage-backed securities and get any useful information about what's going on out of that?
Ooh, that's a very specific question. So I just understand the gist of the housing market in general and what happened in 2008, but I'm not an expert on real estate to make an educated answer for that.
Fair.
Okay. And the other one is, again, coming back to that idea of the potential for a semi-managed MOAS. With all the new DTCC, SEC filings, do you think that things like that have the possibility to help ignite the MOAS, or are they more designed to manage the fallout?
I think it's more of a managed fallout, because I believe that the government has issued some notices towards market regulators and financial institutions, and they kind of know that there has to be some kind of parameters for those defaulting accounts to make sure that another event like this won't happening again. but they are actually expediting the process of triggering that MOAS, because it's one day or not, it's gonna happen. But the thing is, it's better to trigger this thing ASAP, because if they keep kicking the can down the road, eventually the MOAS will get worse for them. So that's where the idea of triggering that said MOAS as soon as possible to limit to limit collateral damage for the bearish market. But it happens when it happens. So whatever.
Right. The analogy I started throwing out a couple days ago is, it's a king size bed. Right now, it's a king size bed with a twin size sheet, and they're trying to cover with it, and they can't. So as they create more and more synthetics to try to keep to kick the can, as we say, what's happening is the bed's getting bigger every time, and the sheet's not getting any bigger. So it's just making the situation worse, which means the fallout will be worse when it eventually happens, in my opinion.
Right. So they're trying their best to make sure you corner that MOAS and contain it. But the thing is, it's impossible to contain it. So the thing is, it's actually better to start it and eventually deal with the fallout, the minimal fallout, because the more they wait, the more the more violent the volcano actually is. So there's that.
Thank you. We have now down to the last two questions, and I think that might be it.
Yep. We'll call that.
Yeah.
What is the best way, in your opinion, obviously not soliciting financial advice, to secure money after the MOAS? Thinking about things like crypto, gold, other options.
So securing money, right? So we're dealing about the fallout of the entire economy. So we're talking about potentially some auxiliary banks going out of business, right? And of course, there's no guarantee that a certain bank would basically be still in service after the crash. So there's that. So let's see on the information.
That kind of brings you back to like the gold, the crypto, the necessities.
Yeah. But I'm not talking about that, but I'll get into it. But the thing is, once you get your tendies, right, and supposedly you have your hundreds of shares or thousands of shares, and you have your millions of dollars under set one brokerage account. That is extremely risky. And of course, the idea is to spread your profits into several brokerage accounts under different institutions, because the thing is you cannot guarantee which bank would actually go bankrupt and go out of business. So that was what happened with the Lehman Brothers, right? You don't want to be part of that Lehman Brothers having one account with them, and eventually you're gonna lose a lot of your money. So we're talking about the FDIC insurance, right? The insurance coverage limit. So right now, for each account, for each depositor, is limited to 250 grand per account. And of course, I'm talking also from the Canadian side. So there's actually an insurance coverage limit up to 100 grand, if I remember well. So there's that. So poor Canadians. The thing is, you have to spread your profits, because you don't know which banks would default and go out of business. So that's where the idea of storing one place for attendees is really bad idea, because you don't know if that service will go out of business in the crash. There's that. So also you have to diversify your portfolio as well, unfortunately, to make sure that your assets are being you want to have that wide exposure to make sure that you're protected in the case of an economic downturn. So make sure that you spread your profits into different assets. So we're talking about inflationary assets in case that inflation would rise up, or it could be essential stocks and whatnot, those hedges. So there's this idea. So that's how you protect your kind of your money, to protect your wealth, because you're actually limiting your risk exposure to the markets. So that's the idea of hedging.
Right. And then just real quick on the 250 for FDIC insured, there's now something called an ICS, which is an insured cash sweep. So if previously you would have had to go to 4 banks to insure $1 million by putting 250,000 in each bank, now there's a system that a lot of banks participate in, where you would give all $1 million to that one bank, but internally they would move it around to 3 other banks as well as themselves, and you would still be fully insured for the 250 at each bank without actually having to do all the legwork or have multiple accounts and multiple points of contact. You'd still go to your primary bank, but they would put some of it here, some of it there, and some of it there for you. So just a thing to keep in mind.
Just cover your ass once you get your millions, because under one account, you're just like inviting yourself, you're just shooting yourself on the foot in case that the bank is defaulting.
The bank goes under.
Yeah.
Yeah, that's the whole purpose, I guess, that they came up with the ICS is to basically make sure that you're putting the money in multiple accounts, multiple banks rather, but without actually having to visit them all. And if the one that you frequented went out of business, you'd still have the money in the 3 other ones, assuming all 3 of them didn't go under.
It's just absolutely stupid to have your millions of attendees, right? You make like 10 million or 15 million, or depending on how much you have invested in those highly shorted securities. And if that bank goes under, and if that brokerage account goes under said bank, you're gonna just retrieve that insurance policy, which is in the $1,000 range, which is actually unfortunate, but it is what it is.
Do you believe that so let's say the brokerage went out of business, they have insurance, and then if the insurance got depleted, then the clearinghouses would come into responsibility, and then if they got depleted, their insurance, and then if they got depleted, the the DTCC, and then if not, their insurance, and then if all else failed, that's when they start printing money. Is that right?
Yeah. Mm-hmm. Well, for the highly shorted securities, when we're talking about hedge funds going bankrupt, that's always a line of differential payments in order. So hedge funds going bankrupt, then insurance kicks in. If that's enough, clearing corporation kicks in. And of course, if that's not enough, their insurance kicks in. And that if that's not enough, well, that's where the government would be printing to save those critical components of the stock market. And of course, inject that money into to basically close that balance sheet that is needed to cover positions.
Right. They would feed it in from the top and it would come out the bottom the same way it got depleted from the bottom.
Exactly.
You got one more, Alvi?
Yes, one more. This
the
is
last question. This person gets a free... Hello. Last question. That's what they get. Go ahead.
Apple.
A free apple. A free apple. Yep.
This is a direct follow-up to what you were just discussing. So how do people spread their money around safely if you only get FDIC insurance of around 250,000? If there's only so many banks, can you recommend brokerages that you think will survive all of this and that would be safer places for us to store our money?
The thing is, we just don't know. The thing is, there are so many banks and financial institutions out there, and of course, they have also placed their own investment into the stock market, and depending if they have made good or bad choices, so that's up to them. But I believe the big giants would still kind of stay around, like Morgan Stanley or those very, very big banks, right? But those minor players that haven't been around for much, they would get basically wiped out from the map. But it's a case by case basis, and I cannot provide guarantees because anything could happen. And of course, what happened to Lehman Brothers? The thing is, it is what it is. Just pray.
Thank you. And the only other thing I wanted to add from all the messages is how much gratitude the community feels for you coming on and sharing your knowledge.
Yeah.
And I've gotten so many thank you DMs directed towards you, Kringle. So we all very much appreciate it.
So
absolutely.
Of course, there will be more classes. So I have already another class prepped up, but I don't believe I will do another class until next week or in 2 weeks. But it's actually a follow-up of that chessboard of finance. So we're gonna have actually people applying these concepts and making sure that they understand that yes, it's a very big chessboard that we're currently on. Yes, it is fucking rigged, but it's actually a way for you guys to get over that manipulation, to get above that manipulation, and get under head of the game. So in case that you're gonna win on the stock market. So that
right. And we're probably going to have a call this week towards something with real estate. So keep an eye out for that. And another call probably Wednesday. So depending on how the schedule unfolds, you guys will get notified probably sometime tomorrow.
So who's gonna be the host for the real estate?
There's 2 people that I'm talking to. I just kind of want to see what their availability is. You know, the timing of these things is hard because you want to kind of give access to the whole country to be on.
Right.
But some people were working earlier, so
Right.
it's really scheduling is going to kind of dictate who it ends up being. But there's 2 really qualified people, so I think maybe we can even get lucky and get them both. So either way, we'll be set.
Nice. Always need experts in on the real estate. So
Yeah, that's the beauty of this environment. I mean, if you have a question, there's somebody that knows the answer.
Mhm.
It's just a matter of getting them and putting something
yeah,
together.
definitely.
I appreciate your time tonight very much.
Yeah,
So.
thank you for listening, and I hope that you have enjoyed this class. So, yeah.
Absolutely.
Yeah.
All right, I'm going to end the call now, and then I'll probably do a quick half hour, just any other unrelated questions that you guys want to go through real quick.
Some kind of
All right.
bar session, right?
Yeah, it's probably gonna have alcohol. It's probably gonna have alcohol involved.
Yeah, until we pass out during the night, and we're gonna call it until tomorrow. That's a good idea.
That's right.
Yeah, fair enough.
Always. Very good. Thank you very much.
Yeah, no problem.
Take care.